As a high-income investor or entrepreneur, why should you welcome a bad year? Hey, this is Justin Hitt from Sustainable Wealth Secrets. According to the IRS, in 2017, if you had a modified gross adjusted income of $133,000 as a single taxpayer or $196,000 as a married couple, you didn't qualify for a Roth IRA. So if you earn too much money, you have a restriction on how much you can save tax-free in order to retire at a lower tax rate. See, the taxes and death are two guarantees. The government will always find a way to tax you. They'll find a way to change the program. And there will be times where your income disqualifies you from benefits that makes your effective tax rate significantly higher. If you're able to invest tax-free now and then receive the money tax-free in the future, then you're in a situation where you didn't pay extra on your income. Now, this is very important because when you earn money, you pay income tax, and then when you spend the money, you pay a sales tax or a value-added tax or some other kind of tax to spend the money. What if you could take out one or the other tax cycles? Now, again, you know I'm not in the business of telling you about specific strategies for your situation. I always say you've got to work with a fee-based financial planner or a CPA or a paid tax advisor who works for you rather than working for commissions. You need to look at your entire picture. I did a calculation on how much tax was taken out of my income, and it was 42%, and that is just ridiculous. Now, with strategies in place, my effective rate came down to almost 20%, but again, you're going to hear all this out in the marketplace about how the wealthy are not paying their fair share. Listen, $133,000 a year for a single taxpayer or $196,000 for a married couple is really not that much, especially if you live in or around a major city, especially if you've got kids, especially if you've got any type of job that pays that where you have $3,000 to $5,000 a year just in continuing education to keep you up with the current skills in the current marketplace. You won't earn that much for very long if you're not investing in yourself. And then again, some of the subscribers have $250,000, $300,000 a year, $400,000 a year. What do you do? Well, I would say welcome those bad years because you know that day the company downsizes, they're looking at the highest income people to let go first. The first time if you're in a sales position that there's a bad economy, a lot of folks in 2008 faced just no fault of their own. Their whole company went under because they were in the mortgage and financial industry. I say welcome that bad year because that year that you make under the limit, that year that you make $50,000, $70,000, $100,000 is the year that you start with conversions. You can do tax-related conversions around traditional IRAs, around other types of retirement accounts. You can max out your contribution. You can start your own business and use a qualified business type retirement account. You can do a number of things. Again, speak your situation with a financial advisor or some tax person. I can't see your balance sheet from where I'm sitting. But the key of it is that when that bad year comes, don't worry about it. I know a lot of you folks are worried about that it's going to look like, hey, you were out of work, you're unemployed, that you weren't valuable in the marketplace. Well, what about a leap year? Hey, things were going well, and after the economy crashed, I thought I would take a year to invest in my education, spend a little bit more time with family, determining whether or not I want to continue in this field or do I need to approach it a different way. See, it's how you describe the situation to yourself and others that matters. You still want to be looking for work because if you're used to a $300,000 a year income and you now have a zero income, you need to get those numbers back. But again, with the right savings program, with the right investments, with the right cash flow management, you could take a hit like that and it could have been the best thing ever for your future self. So you can max out on these accounts. You can find and explore different opportunities. You can go in and try a different industry. and it gives you the flexibility. So these down years, when they happen, I know a lot of folks come to the newsletter at the end of their straw, and they're I guess got to find a way to get back where I was, because a stretched wallet never comes back to its original size. Once you're used to $10, $15, $20,000 a month, it is hard to go to zero. However, if you're using my intentional thrift program, you can see how a lot of high income or high net worth individuals, actually they started out high income and became high net worth because of this, how they spent their money. In a down year, you might have assets you can convert. You can sell winners in your portfolio and have a lower tax if it's a short-term gain. You can ultimately start building your portfolio by qualifying for loans. So we talked about opportunity zones in another program. Well, if you've got $200,000 a year in income, there's not much you qualify for, even in an opportunity zone or a hub zone or an enterprise zone. But you have a bad year and your adjusted gross income is $40,000 or your actual income is $40,000. They aren't going to look at all your savings and investments. You can structure. It depends on how you're set up. You can structure, and you can actually have a high income, $200,000-$300,000 coming through a business that's reinvested in the business to grow that business, meaning no money for you, and you still have an okay lifestyle. But because you're not receiving any money, you qualify for different types of programs. Now, of course, if you're making a lot of money, you qualify for bank loans. You qualify for lines of credit. But whatever you're doing, these slow and slender times become a setup. They become an opportunity for you to save on taxes, for you to shift here's an example. So a bunch of regulations come out in your marketplace, and it's cheaper for you to shut down the business than it is to stay in the business because your regulatory costs have gone through the roof. Well, that's fine. Liquidate, shut it down, transition into a business that fits. That might take a year, and then you'll be right back on your feet. Again, it goes down into the basics of what are you doing with that free net cash flow. So you got to know that you've got free net cash flow. And then what are you doing with that free net cash flow? Well, if you're putting it into assets that cash flow, so assets that pay for themselves, that generate a cash flow, even if it's a few dollars a month, $150 a month, no big deal. You're accounting for your labor hours. So if you are calculating cash flow, you have some kind of concept of overhead so that you know that you're not spending more physical time and you're having this opportunity cost to try to squeeze out a little bit of cash flow. You need to know that cash flow is real. And even a bad month can be that reassessment, that review. Now, you need a bad year in order to have these tax advantages of like converting retirement accounts into tax-free accounts. My assumption is that in the future, inflation is going to be higher, so you're going to have less buying power, and taxes are either going to be the same or they're going to be higher. And so in my retirement, I don't want to be paying taxes. I want to have already paid taxes on the money, which has a disadvantage too because you're using higher value money. But either way, if you're monitoring free cash flow, you're going to be in a position where you're going to be able to spin off what you need. And so if you're able to spin off the money to cover the taxes, great, you can calculate that. If not, and you happen to have a bad year, I'm not wishing a bad year on anybody, but if it does come, don't get all upset. Don't let that fear and upset distract you from the opportunity that's there. But if you have a bad year, you can certainly reshuffle, recalculate. On your resume, a lot of folks are worried about the gaps on their resume. If you're in an employment environment, you can say, hey, look, I took an opportunity to explore a new venture. You could go work for a startup, for example. Normally you wouldn't work for a startup because you're making good money elsewhere. Startups have a lot of risk, but look, you had a bad year. Reach out into your network, find out who's running a startup, offer your expertise on a consulting basis, take equity. There's so many people across the table in an employment situation who would have loved to just take a sabbatical. I'm not saying take a sabbatical and sit around and do nothing, but ultimately, again, these setbacks are setups, as Les Brown says. The ultimate focus, though, is will your current net cash flow remain? So you could have lost your full-time job, but still have enough income from dividends that instead of reinvesting dividends, you use them to pay your monthly expenses while you're getting ready the next position or the next opportunity. Maybe you have a situation where you can liquidate assets where having a lower gross income or lower adjusted gross income qualifies you to take the ordinary income at a lower tax rate. And then, of course, the situation we mentioned about IRA conversions. My final point is, if your current net cash flow is clean and your future net cash flow can remain clean, then it doesn't really matter what happens day to day. These are just little bumps in the road. They're not going to distract you or take you away from the sustainable wealth we're looking for. See, that's what makes it sustainable, is that you are clear that there's multiple streams of income. If you lose one stream of income, even if it's a significant one, it's not going to destroy your ability to have a basic living. You're in a position to be ready. It means you got to have an opportunity in the queue that when your every day or every hour rate is low enough, you can go take on this opportunity to bring your every hour rate up. And then you have parallel tasks where even though you might be starting this company, you might still be looking for new opportunities. Both of those areas could be the same. You're not going to open an ice cream shop and look for a software development job at the same time, unless you've got family members involved and it fits your model and you've got a good business plan. You're going to look for freelance software development opportunities as well as looking for a full-time software development position if that's what you're in. Maybe your business got hit like the mortgage brokers. Well, maybe you're going to look for a different area in the financial services business. Maybe you're going to take the data from your company and use that data for folks buying repos. There's different ways to approach this. The key is, again, setbacks. Don't be afraid of them. If something bad goes and you've got your current and future cash flow straight, you're going to know what your cash flow is without your primary income. And if it's not satisfactory, what do you do about it now? You're going to know that if you have high taxes in retirement, what kind of assets can you sell off? Real estate is a great asset because very often real estate can show a loss on the books, but actually break even in the marketplace. So you could have a break even from rent and the labor that goes into maintaining a house, but ultimately the depreciation turns it into a loss. And again, these are things that you discuss with your tax person. The main purpose of this newsletter and the podcast and everything that's around it is so that you're informed, so that when you sit down with somebody, you can ask questions that are going to protect your long-term interests, that are going to help set up additional cash flow. I got a property right now that's got a roof on it that needs to be replaced. Because the roof is old, the insurance is 4 times what the insurance normally would be. So I can calculate my break-even point between paying the higher insurance and replacing the roof. Now, if the house becomes a rental property, I can replace the roof as part of a capital expenditure, and then over time recover a lot of that roof expense in the losses on the property. I might not actually have any losses on the property from a cash flow basis, but from a tax basis, I'm lowering my adjusted gross income, which could then qualify. So again, you could have a loss of job, you could have an economic change, you could have a major expense. Welcome it. In fact, you can plan for it in advance, but welcome it. Because it could be that opportunity you need to save $30,000, $40,000 on your taxes. Now, again, I'm not a tax advisor. I'm not a financial planner. I hire these people to help me out. Essentially, what I do for you, though, is collect this resource and information and give it to you so you can ask great questions when you're working with financial folks, so that you can, whether you have a virtual family office or larger, you can know whether they're BSing you. Whether you have a small family group that gets together through a family business, you can tell whether or not that's the right place for you to be. Whether you have a high income and you're working in a corporate environment and you've been dreaming about being a farmer, well, you can do the numbers to see what's right for you. I'm Justin Hitt with Sustainable Wealth Secrets. You can ask your questions at www.sustainablewealthsecrets.com. Thanks for listening. Thanks for sharing this podcast. And thanks for your questions. I appreciate the chance to interact with you and to find out what you're concerned about so that we can get you solutions.